Hey everyone, and welcome back for another deep dive. Today we're putting on our investor hats and tackling a topic that's probably on a lot of your minds: dividend investing. Specifically, we're looking at two Vanguard ETFs that the Motley Fool recently highlighted as potentially great long-term holds. Now, you know how much I love a good deep dive, and when it comes to building a portfolio for the long haul, you can't beat those steady dividend payouts, right?
Absolutely. And finding those reliable dividend payers is key, especially if you're looking for investments you can buy and hold for years to come.
Exactly. So to help us unpack all of this, we're taking a closer look at two Vanguard ETFs that dividend investors can buy and hold forever, an article published by the Motley Fool just a few days ago on September 27th. And just a reminder before we go any further, this isn't financial advice. We're just here to break down the details and see what we can learn.
All right, let's jump right in with the first ETF on our list, the Vanguard Value Index Fund ETF shares, or VTG for short. Now, one of the first things that caught my eye with this one is the incredibly low expense ratio. We're talking a minuscule 0.04%. That means more of your returns stay right where they belong in your pocket.
It's definitely one of the lowest expense ratios you'll find out there. Vanguard is known for their low fees, but this is exceptionally tiny, even for them.
Okay, so low fees, check. But let's talk dividends. This ETF boasts a 2.3% dividend yield. That's a whole percentage point higher than the S&P 500 average, which is hovering around 1.3% these days. For dividend-focused investors, that difference can really add up over time. Now, the article calls this a lower-risk ETF. Many investors tend to see those large-cap companies as safer bets. But how does VTV's sector allocation play into its overall risk profile?
That's a great point. It's not just about the size of the companies, but also their areas of operation. VTV does lean heavily towards certain sectors, which can impact its risk profile. We're talking about well-established giants in sectors like finance and healthcare. Think Berkshire Hathaway, JP Morgan Chase, United Health Group.
Those are some seriously big names. You're right, they're practically household names.
Exactly. And that brings us to the value part of this ETF. It's all about how the market values these companies relative to their earnings. VTV's average price-to-earnings ratio, or PE ratio, hovers around 21. This suggests that investors are paying $21 for every $1 of earnings these companies generate, which is considered relatively low compared to the broader market.
So we're essentially talking about potentially undervalued companies with a history of solid earnings. Sounds promising. But how has VTV actually performed for investors? I'm curious to see those numbers.
Well, over the past decade, this ETF has delivered a solid 171% in total returns. That translates to an average annual return of about 10.5%. And remember, that includes those consistent dividend payouts we talked about.
10.5% average annual returns over a decade. That's a pretty compelling figure. It really highlights how long-term growth can snowball over time, especially when those dividends are reinvested.
Okay, so we've covered VTV. What about the second ETF on our list?
The next one is the Vanguard High Dividend Yield Index Fund ETF shares, or VYM for short.
VYM. Got it. Now, what makes this ETF different from VTV? I'm guessing it has something to do with that high dividend yield in the name?
You guessed it. VYM comes with a slightly higher dividend yield of 2.8% compared to VTV's 2.3%. However, as with most things in investing, there's a bit of a trade-off. While the potential for higher income is there, it's important to note that VYM might have a slightly higher risk profile as well. A classic case of risk versus reward, right? Higher potential return often comes with higher potential risk. But we're still in the realm of large cap stocks, so it's not like we're diving headfirst into the world of microcaps or anything.
Exactly. VYM still prioritizes those large cap companies, which tend to offer more stability compared to their smaller counterparts. It aims to provide a balance between seeking higher income and staying within that large cap comfort zone.
I noticed that this ETF holds a whopping 550 stocks. That's a significantly more diversified basket than VTV. Are we still seeing familiar names in the top holdings?
Oh, absolutely. You'll find some long-standing dividend payers in there, like Johnson & Johnson, Procter & Gamble, and ExxonMobil. These are companies known for consistently sharing profits with their investors through thick and thin.
They're practically institutions at this point. But it's not just about paying dividends, right? These companies are known for their dividend growth over time as well. That's a crucial factor for long-term investors.
Absolutely. For long-term investors, it's about more than just the current yield. It's about that potential for growth to outpace inflation and contribute to building wealth steadily. And these companies have a pretty impressive track record in that regard. Their dividend payouts haven't just been consistent, they've been steadily increasing over the years.
All right, that's what I like to hear. Consistent dividend growth is music to my ears. Now, let's shift gears and talk about VYM's historical performance. Has it managed to keep pace with VTV?
While VYM might not have reached the same heights as VTV over the past decade, its 10-year performance is still nothing to scoff at. We're talking about a solid 160% total return, which still demonstrates its ability to generate returns for investors.
160% total return over a decade. That's still incredibly impressive. Okay, so we've covered two compelling ETFs, both potential candidates for long-term holdings in a dividend-focused portfolio. But before we wrap up, let's talk about what this all means for our listeners.
Absolutely. What's important to remember is that both VTV and VYM offer something unique. VTV might be a better fit for those who prioritize lower risk, while VYM could be more appealing to investors who are comfortable with a slightly higher risk profile in pursuit of those potentially juicier dividend payouts.
It's all about finding the right fit for your personal risk tolerance and financial goals. And of course, we always encourage our listeners to do their own research before making any investment decisions. This deep dive is just the starting point, a jumping-off point for your own exploration.
Couldn't agree more. It's essential to look beyond just the dividend yield and consider factors like your own risk appetite, investment timeline, and overall financial goals. There's no one-size-fits-all approach to investing.
Exactly. What works for one investor might not work for another. Now, before we wrap up completely, I want to leave our listeners with something to ponder. We've talked about the potential benefits of focusing on large-cap stocks, but what about the flip side? What are some potential drawbacks of solely focusing on this segment of the market?
That's a great question. It's always important to consider different perspectives and potential downsides. One potential drawback is that by focusing solely on large-cap stocks, investors might miss out on the growth potential of smaller companies.
That's a really important point. Diversification is key. And that brings me to another question for our listeners to chew on. How can you diversify your portfolio even further? Is it enough to simply invest in both VTV and VYM? Or are there other avenues worth exploring?
That's the kind of big picture thinking we love to encourage here. It's easy to get caught up in the details of specific ETFs, but zooming out and considering your overall portfolio strategy is crucial.
What a fantastic analogy.
Yeah.
So for our listeners who might be thinking, okay, this is all great, but where do I even start with diversifying beyond large cap stocks? What would you recommend as a first step?
I always encourage people to, first, think about their investment goals and risk tolerance. From there, you can explore different asset classes like small cap stocks, international stocks, bonds, real estate, or even commodities.
It's about finding that balance between managing risk and maximizing returns. It's a journey, not a destination, right?
Precisely, and one that requires ongoing learning, research, and maybe even seeking advice from a financial professional when needed.
Couldn't agree more. Well, I think we've given our listeners plenty to think about today. We've explored two compelling Vanguard ETFs, VTV and VYM, delved into the ins and outs of dividend investing, and even touched on the importance of diversification.
It's been a pleasure diving deep into these topics with you.
The feeling is mutual, and a huge thank you to all of you for joining us on this deep dive. Remember, the world of investing is vast and constantly evolving. Keep asking those questions, stay curious, and never stop learning. Until next time.